Welcome to a new episode of Inside the Economist's Mind. Today we're taking a deep dive into the value of the Australian dollar, the AUD. We'll be unpacking the various factors that cause our dollar to rise and fall, and we're drawing on an explainer from the Reserve Bank of Australia.
Yeah, a really useful one.
Our mission, really, is to give you a clear handle on why the Aussie dollar moves the way it does.
Exactly. And understanding these forces behind the AUD is, well, it's key, isn't it? Whether you're planning a holiday or just keeping up with the news.
Or running a business with international links.
Absolutely. So we'll look at the long-term trends and also those more immediate ups and downs.
Trying to give you a comprehensive but still, easy to grasp picture.
That's the plan.
Okay, let's unpack this then. So at its most basic level, the exchange rate is just what one currency is worth in terms of another one.
Simple as that.
Like the AUD rate tells you how many US dollars you get for one Aussie dollar. And if our dollar strengthens, that's appreciation. If it weakens, depreciation. Pretty straightforward, right?
Indeed. And a really significant long-term influence on these shifts is the difference in interest rates between Australia and other major advanced economies,
Yeah.
U.S., Europe, Japan. That interest rate differential, it's a key driver of capital flows.
Capital flows. So money moving in and out.
Exactly. Money moving for investment purposes.
Okay, here's where it gets interesting. So imagine Australian interest rates are higher than, say, U.S. rates. Suddenly, Australian investments, maybe government bonds, look more appealing to foreign investors. Better return.
That's right. They offer a better yield. So what happens next?
Well, these investors, they want to buy those Aussie assets.
Right, please.
They need Aussie dollars.
Precisely. So you get this increased demand for AUD. And maybe fewer Aussies invest overseas because returns are better here, so that potentially reduces the supply of AUD hitting the market.
And that combination, more demand, less supply, pushes the dollar up. Appreciation.
You got it.
Okay.
So the RBA's decisions on interest rates, they have a pretty direct impact there.
Okay, so flip side, if our interest rates are lower, less attractive for foreigners?
Yeah. Australian assets look less appealing then. Investors might look elsewhere for better returns.
Leading to less demand for AUD?
And possibly more supply, as Australians might invest more overseas.
Which causes our dollar to weaken or depreciate. It's like this global search for the best returns.
That's a good way to put it. And while interest rates are a big draw, it's worth remembering investors also look at risk.
Sure, the perceived safety of investing somewhere.
Right. But that interest rate differential, still a crucial long-term factor for the AUD.
Okay, let's shift gears a bit. Another long-term thing. The terms of trade and commodity prices. Sounds technical.
It does, but for a country like Australia, it's fundamental. We're rich in natural resources.
Right. So terms of trade. That's the ratio of export prices to import prices.
Basically, yeah. What we get for our exports versus what we pay for imports. And for Australia, a huge chunk of our exports are commodities.
Iron ore, natural gas, coal, farm products.
Exactly. Things dug out of the ground or grown here.
So if the global price of iron ore shoots up, that's generally good for us. We're selling it for more.
That's right. Higher commodity prices improve our terms of trade. The value of our exports goes up compared to imports.
And how does that hit the dollar?
Well, it leads to greater demand for Australian dollars.
Yeah.
International buyers need more AUD to pay for our commodities, which are now more valuable.
So demand for AUD rises and the dollar tends to appreciate.
Correct. And that's a key reason you often hear the AUD called a commodity currency. Its fate is sort of tied to resource prices.
I remember the mining boom, mid-2000s to, 2013?
Yeah, big period.
Commodity prices were sky high then, and our dollar went above $1.10 US. That wasn't just random, was it?
Not at all. Those high prices fueled massive investment in expanding mining capacity here.
Building new mines, infrastructure.
Exactly. And a lot of that expansion was funded by foreign capital coming into Australia.
Which meant even more demand for AUD.
Yep, further boosting the dollar. It's a really clear example of how global demand for our resources feeds directly into our currency's value.
Okay, so higher interest rates pull money in, boosting the dollar. Higher commodity prices do the same. What about just the everyday buying and selling of goods and services across borders, international trade?
Yeah, international trade is obviously a bedrock driver of currency demand and supply.
So if Australia exports something like wine to Europe.
Okay, let's say the European buyer needs to pay in Aussie dollars. They have to sell euros and buy AUD.
Increasing demand for our currency.
Right, pushing its value up, potentially.
Makes sense. We sell stuff, people need our money. What about when we buy things from overseas, like electronics from Korea?
Right, when we import. Australian buyers need to sell Australian dollars.
To get the Korean one to pay the manufacturer.
Exactly. So that increases the supply of Aussie dollars out there in the market.
Which could lead to depreciation, downward pressure.
Generally, yeah. So, a strong export performance tends to support the AUD, while lots of imports can weigh on it.
Okay, now this next one feels a bit more theoretical. Prices and inflation. I've heard of purchasing power parity, PPP.
Ah, PPP.
Yeah.
Yeah, it's a theory, mostly for the long run.
Okay.
It suggests exchange rates should adjust so that the price of an identical basket of goods and services is, well, equal across different countries.
Like the law of one price, but applied globally.
That's the core idea.
So if, say, a coffee costs way more in Sydney than in Seattle after converting currencies...
PPP suggests that eventually the exchange rate between the AUD and USD should adjust to make those coffee prices roughly the same.
How would that work, though?
Well, if Australian goods become really expensive compared to overseas...
People might buy fewer Aussie goods.
Could happen, yeah. Demand for them might drop.
Yeah.
That reduces demand for Aussie dollars, potentially leading to depreciation.
And if the AUD weakens?
Then our goods become cheaper for foreigners, which could then boost demand again. It's sort of a self-correcting idea over the long term.
I remember the Economist's Big Mac Index uses burger prices.
Haha, yeah. That's a fun, real-world take on PPP.
Yeah.
Is a Big Mac overpriced or underpriced somewhere based on the current exchange rate?
A simplified way to see if currencies reflect relative purchasing power.
Exactly. It gets the concept across.
Okay, so those are some of the big longer-term forces. What about the day-to-day or week-to-week jumps and falls we see? The short-term stuff.
Right. In the short term, risk, sentiment, and speculation become much bigger players.
Sentiment? You mean how willing investors are to take risks?
Yeah, basically their mood. When the global economic outlook seems positive and stable, investors often feel more comfortable taking on a bit more risk.
And they might see Australia as a good place for that.
Sometimes, yeah. Currencies like the Aussie dollar are sometimes seen as carrying a bit more risk than, say, the US dollar or the Japanese yen, which are traditional safe havens.
So, good global mood. Investors feel brave by AUD.
That often happens. Increased appetite for risk tends to lead to higher demand for the AUD, pushing it up.
So, if the world economy looks sunny, our dollar often strengthens.
Precisely. You often see a correlation between the AUD and global stock markets. Stocks up, AUD often up, stocks down, AUD often down.
Interesting. And speculation, people just betting on the direction.
Yep. Investors and traders try to predict future movements, buying or selling AUD purely to make a profit from those shifts. And that activity itself can influence the exchange rate in the short term.
So short term, it's partly about global optimism, partly about market bets.
That's a big part of it, yes.
Okay, now, Australia has a floating exchange rate, right? The market mostly decides the value.
Correct.
But can the Reserve Bank, the RBA, ever step in, intervene directly?
Yes, they can, though it's become much less frequent over the years.
Under what circumstances would they do that?
Generally only in pretty specific situations, maybe if the market becomes really disorderly or dysfunctional.
What does disorderly look like in a currency market?
It could mean there's a huge imbalance between buyers and sellers. Like almost everyone wants to sell AUD and hardly anyone wants to buy, or vice versa, a one-sided market.
And that causes problems.
Yeah, you can get massive rapid swings in the exchange rate, extreme volatility that disrupts normal business.
So if everyone's dumping AUD and the price is plummeting really fast in a chaotic way.
Exactly. In a situation like that, the RBA might step in. They could say, buy Australian dollars.
Using their foreign currency reserves, like US dollars.
Yep, typically selling USD to buy AUD. The idea is to add some demand, counterbalance the selling pressure, reduce that extreme volatility, and just help the market function better.
Did they do that during the GFC, the financial crisis?
They did, yeah. Back in 2007-08, the AUD fell very sharply, very quickly, and they intervened to provide some stability.
So their goal isn't really to set a specific price for the dollar.
No, not usually.
It's more about smoothing out those really wild, erratic swings, keeping the market working.
That's generally the focus now. Addressing acute market problems, not dictating the long-term level. And like I said, it's a tool they use much more selectively these days.
Okay, wow. So, quick recap then. We've covered the long-term drivers, interest rate differences, capital flows.
In terms of trade, commodity prices.
International trade itself, and that PPP idea about prices and inflation. And then for the shorter term, risk sentiment, the global mood and speculation.
Yep.
And finally, how the RBA can occasionally step in to calm a dysfunctional market.
Exactly. Ultimately, the value of the Aussie dollar, because it floats, is all about that constant dance of demand and supply in the market.
And all these factors we've talked about are what shape that demand and supply.
Constantly interacting, yeah.
Reflecting on all this, it really makes you think, doesn't it? Which of these factors feels like the most important one right now for the Aussie dollar?
It's a great question to keep in mind.
Definitely gives you a better lens for watching the economic news and seeing how it might connect to the dollar's movements.
It certainly does. And for anyone listening who wants to dig even deeper, the RBA website has a ton of great information. Explainers, research papers.
Good tip. Worth checking out.
Definitely.
Well, that brings us to the end of this deep dive into what drives the Australian dollar. Thanks for tuning in to Inside the Economist's Mind.